Let's say you're playing golf with a buddy, and you find out that your buddy's neighbor Jim sold his company for 10x company earnings. A year goes by, and you're having beer with a friend, and she tells you she just sold her company for 6 times her profits. Then you pick up the Wall Street Journal, and come to find out that someone got acquired for 17x their earnings. So what does this tell you? If you're the typical business owner, everyone has trained you to look at your business value as a multiple of your earnings. As a result, many of you out there are waiting to get your earnings to a certain amount before you go sell your business. But let me tell you, there's more to your selling price than the selling multiple. Let's say you're buying a house for $1 million. When you get the inspection report in the house, you discover there are termites as well as foundation issues. What would you do? If you wanted the house bad enough, you'd ask for an allowance from the seller for repairs, or you would ask to reduce the purchase price, correct? Let's take this analogy to the business world. While the selling price of your company will likely be determined using a multiple of your company's profits, but by the time the transaction closes, the selling price will most likely get adjusted for the buyer's risks, i.e. the deficiencies, errors, inefficiencies, liabilities, and problems that lurk within the business. In other words, your company's termites and foundation issues. And as a result, your buyer will demand a lower selling price, or the buyer will walk away. So what does this tell you? Instead of just focusing on increasing revenues and profits to improve your company's value, you can in many cases increase the company's value just as dramatically simply by reducing risk. Let me say it in different words. You can increase the value of your business without increasing revenues or profits. All you have to do is decrease the risk in your business. Which is why, if you get yourself in the mindset that your business multiple will be a result of your underlying risk, you will look at your business entirely differently. So let's talk about what's the fix. For starters, reduce reliance on yourself. The less the business relies upon you as a business owner, the higher the potential valuation. Next, reduce concentrations. If you have a handful of large customers driving the bulk of your sales, or your company relies too heavily on a key supplier, which cannot be easily replaced, you need to lay out a plan to start reducing these risks. Invest in systems and procedures. This improves the performance of the business, improves operating efficiencies, and eliminates redundant and repetitive tasks, and most importantly, reduces risk. Diversify industries. If you focus on one specific industry, consider branching out into another industry. Or if you're stuck with your industry, consider branching out in a subsector, so just in case there's an industry downturn, it minimizes additional buyer risk. Increase financial transparency. The higher your quality of financials, including your company's operating and performance metrics, generally the more comfortable your buyer will be. In order to understand lowering risk, you must put yourself into the shoes of the buyer. What a buyer wants is the least amount of risk for the money being paid, and to ensure that your company will continue to perform and sustain its growth and cash flow long after you've gone. Rare Brain Capital helps companies like yours improve performance and sell for maximum value. How ready is your company to grow or sell? Come see how you're doing. Get your free score and customized report in just a few minutes at no cost or obligation. Visit rarebrain.com/score.